And this all the stuff we've talked about all these years, Elijah, about how much silver is there really in the world? The supply deficit over the last 4 years. How much free float is there in London? How many ounces are levered? How many times supporting the derivative markets? All that stuff. If we set off on this, breakthrough 50 and everybody starts getting excited and the banks don't want to fool around with it anymore because they don't have it, they don't want to deliver theirs out or whatever, things could really get spicy next year.
Silver has once again taken center stage in global markets, with prices smashing through the critical $40 barrier to reach $40.57 per ounce as of September 2025, a level investors haven't witnessed in nearly 14 years. The metal's 45% year-to-date surge has transformed sentiment across the precious metals landscape, positioning silver as the standout performer of the year. For both seasoned investors and first-time entrants, this breakout past the long-standing resistance marks more than just a milestone. It signals the beginning of what could be a transformative era for the silver market. According to market veteran Craig Hemke, this move is not an isolated spike, but part of a much larger structural shift that could redefine silver's role in global finance. A critical factor behind this surge is the unique dynamic of silver's market size relative to gold. While gold commands an annual valuation exceeding $180 billion, silver operates in a much thinner market worth roughly $25 billion. This structural difference means that silver reacts with far greater sensitivity to capital inflows. Even a seemingly small reallocation of $1 billion into silver equates to nearly 4% of its total market size, enough to create sharp price dislocations. Hemke stresses that this leverage-like quality explains silver's volatility, but also its explosive upside during periods of heightened investor interest, especially when confidence in paper-based assets begins to erode. Macroeconomic conditions have also set the stage for silver's breakout. Expectations of interest rate cuts by the Federal Reserve have weakened the dollar, making precious metals more attractive as alternative stores of value. Persistent inflation, still running above official targets, has further pushed investors toward tangible assets like silver that hold their purchasing power when fiat currencies falter. The combination of monetary policy uncertainty, dollar weakness, and elevated inflation forms the perfect storm for silver's revaluation. When traditional hedges like bonds fail to provide security, capital inevitably migrates into hard assets, with silver now emerging as one of the most compelling options. Before we dive into Craig's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I'm not in that crazy breakout camp just yet. I think it's an important time for people to be paying attention to what's going on internally with silver. In April of 2011, okay, so most people remember that, price went from 38 to 48 in about 4 weeks of that month, over the course of the month. And it was assumed, it was written up, and people look back, with revisionist history and make it sound like it was a big speculative bubble. What was actually going on, if you followed the commitment of traders report back then, was a commercial short squeeze. They had all these speculators that are long, all these commercials that are short, and they started having to cover shorts for, without going into all the details as to who was short and why and all that stuff. But you could just see it on the commitment of traders reports. And that's what took it from 38 to 48. I think, could we have a similar month now? Of course. But we want to be watching those commitment of traders reports because it'll tell you a lot. If the commercial side of that equation is aggressively adding new shorts this month, okay, well, we're just in that kind of stair-step phase, of 2 steps forward and 1 step back. But if we start seeing a lot of commercial short covering without a lot of new speculative money yet, and that's what drives us, well, then, when we get that breakout of, top of the cup, then you get this big rush of speculative money that just catapults you further. Because silver's a lot like, and I'm sure I've used this metaphor before, it's like Newton's law of inertia or motion or whatever it is. I took physics, but it was a long time ago. An object at rest remains at rest until a force is applied to it, right? Just sit there. My computer right here, but if I push it, okay, it'll remain at rest until a force. And that's kind of what silver's like. Silver just sit there, as we all know, and just do jack for a long period of time, even like not keeping up with gold because people are waiting. They're like, well, I'm not going to get involved in silver yet because it's just sitting there doing nothing. But then as it starts to get moving, then you get this kind of FOMO thing. hey, we've seen this before. And so what will probably happen, I would not expect it to smash through the $48 to $50 all-time highs in the first try. That's generally not how it works. And so I wouldn't think we would get there this year. You go up, we could go to, I think the next move is, in this current move, is probably to 43 and a half, 44, given the channel that we've been tracking higher. Pull back, maybe under certain conditions, we make another run later this year. I think it's in next year. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through. You go up, tap it, find resistance, finally break through. Everybody goes crazy, and then it pulls back, tests that old resistance level for support. And if it finds the support and you stay above 50 and then start making new highs after that, well, then, holy Toledo, then we could have some fun. And this all the stuff we've talked about all these years, Elijah, about how much silver is there really in the world? The supply deficit over the last 4 years. How much free float is there in London? How many ounces are levered? How many times supporting the derivative markets? All that stuff. If we set off on this, break through 50 and everybody starts getting excited and the banks don't want to fool around with it anymore because they don't have it, they don't want to deliver theirs out or whatever, things could really get spicy next year. I saw that stuff too last week. There were 9,000, I can't remember, 9,900 or something COMEX September silver contracts that were open and standing for delivery when that contract went off the board. And then it gets delivered against, you got to be 100% margin long covered so that you can take delivery if that, you're long and somebody the short puts the silver to you. And, historically, that's a lot. But back in March and May, we were doing 18,000 contracts. Okay, so it's not like, oh, wow, it's 10,000 in September, the system. No, it's not. No, not yet, at least. Okay, but it is a not insignificant amount. If we've already delivered almost all of those, that's 50 million ounces. I don't know if it ever actually leaves the COMEX or if it's still just this, oh, this month I'll take delivery, next month you take delivery stuff. So we'll keep an eye on that. I don't think that's where the stress is. After kind of getting excited about that 15 years ago, I don't think that it's the COMEX where you'll see delivery stress. It's more likely in London. I'll give you this. I mean, you've seen over the years, Elijah, and I'm sure everybody listening has seen this, where like Stan Druckenmiller or Ray Dalio or, whomever, some big hedge fund manager, they'll say, we want to own gold. And you're like, good. And then they buy the GLD, right? And you're like, well, what good is that? I mean, that gives you price exposure, but you don't really, you can't take delivery Stan. You can't take delivery Ray. Okay, well, there's this news last week. It looked like the Saudi whatever sovereign wealth fund had bought $1 billion worth of the SLV. Did you see that? Well, I thought that was interesting. Now, maybe they're just playing the same, we just want price exposure and liquidity game like Druckenmiller. Maybe they wanted the silver and maybe they were told, we don't have that much to deliver. If you ask for it, here in the city of London, we can't ship that to you on a timely basis. Would you please just buy this instead? So it'll be, like I said, I don't think, everybody gets all excited about the COMEX and will the COMEX fail? I think your delivery stress is going to be found, if the house of cards start to collapse, it's going to emanate from London or it's going to emanate from one of these unallocated pool accounts things that some places run, that could set off almost like a little mini bank run. I'd say that's more important.
Beyond traditional investment flows, silver's industrial demand has become one of the most powerful drivers of its rally, creating a fundamental tailwind that shows no signs of slowing. Unlike gold, which is primarily held as a monetary asset, silver is indispensable to modern technology. Its unmatched conductivity and versatility make it critical for green energy solutions, such as solar panels, electric vehicles, and advanced electronics. Industry figures reveal that each electric vehicle requires between 25 and 50 grams of silver, while every solar panel consumes 15 to 20 grams. With global EV production projected to surpass 30 million units in 2025 and solar installations accelerating worldwide, the scale of demand has reached historic levels. This is occurring against the backdrop of 5 straight years of supply deficits, with shortfalls averaging 140 to 150 million ounces annually, leaving the market in a persistent imbalance that exerts lasting upward pressure on prices. On the supply side, constraints are proving just as influential in shaping silver's trajectory. Nearly 70% of global silver output comes as a byproduct of base metal mining, primarily copper, zinc, and lead, which means production is tied not to silver's own fundamentals, but to the economics of those larger industries. Compounding the issue, ore grades at primary silver mines have deteriorated sharply over the past decade, falling by nearly 25%. This means miners must extract and process far more rock for the same amount of silver, raising costs and limiting efficiency. Craig Hemke has emphasized that these structural limitations are not temporary setbacks, but long-term challenges. When combined with surging industrial demand and growing investor appetite, these constraints create the conditions for what he describes as an explosive revaluation, as the market is forced to acknowledge that current prices do not reflect underlying realities.
Well, there's a number of things that are combining. A big picture, right? We had a 25% year in gold last year, which was the third time, maybe fourth time this century that's happened. Every year that has followed a 25% year has been, I think the best we've done is 10. Sometimes just give a part of it right back. So the fact that at least here we are in September and we've already tacked on another 30% should be an alarm bell for everybody. And the proper way to look at this is not that gold is becoming more expensive. It is the dollar which is losing its purchasing power versus gold. We talked 10 years ago, Elijah, it took 1,500, Federal Reserve notes, or 1,200 back at the bottom, 1,100 Federal Reserve notes to buy an ounce of gold. And then 5 years ago, it was 2,200, and now it's 3,500. It's the gold's not changing. It's how many dollars it takes to acquire it that's changing. Lastly, what you're seeing even today is the price has been steadily moving upward over the last 2 years. And it surges it breaks out, it surges 15%, it consolidates for another 3-4 months, breaks out, surges 15, 20%, consolidates for 3 or 4 months. This has happened 3 or 4 times now. And as most people know, it's been consolidated under 3,500 since about April or May. It's now broken out, and I think there's a rush of speculative interest because another 15%, if we keep the pattern going, takes us up to about $4,000 an ounce. That's the deception of the dollar index, because it just compares the US dollar versus all this other equally worthless fiat, right? And so the dollar over time, you pull up a 30-year price chart of the dollar index, and it's 100 and it goes up to 120 and down to 80, and it just stays basically the same. Well, that's because all the other fiat currencies are devaluing at the same rate. Elijah, do you remember, I'm sure we did a call like this back in January after I published my yearly forecast. Do you remember doing that?
Yes, yeah, definitely.
Okay. I had a line in there. I was just reminding people on my site this morning. But I said, expect more rate cuts than what people are thinking are coming. And furthermore, don't be surprised if by December, the December FOMC meeting, the Fed isn't openly talking about yield curve control. And I mean, I wrote that like on New Year's Eve last year. There was nobody talking about yield curve control. But now, all of a sudden, here in late August, early September, it's like, oh yeah, yield curve control is coming, like everybody was predicting this 8 months ago. Yield curve control is coming. Whether it's globally, if all these central banks have to do that to control the long end of their curve, right, and control their interest costs. But I think you're definitely being told and warned that it's coming here in the U.S. And I think that's all part of what's driving gold too, because that would be extremely bullish news for gold. You'd be holding real interest rates sharply negative. I mean, the U.S. has done this before, which is why I wrote about it in my pod. I even put a link in there in that macrocast, because coming out of World War II, when we had similar debt to GDP ratios, that's what they did. They kind of combined the Fed and the Treasury together. They did yield curve control, essentially to pay off the debts of yesterday with the cheaper money of tomorrow, right? Get it under control, grow your way out of it, which is what Besant keeps talking about now. Well, anyway, if you want to take the time, to connect the dots, I mean, I think they're telling you that's what's coming as soon as next year, once Powell gets replaced and everything else. And so if that's the case, they're going to be trying to cap the long end. It's going to involve a lot of new quantitative easing measures, central banks buying their own debt, monetizing, almost like a modern monetary theory move. Again, all of this is extraordinarily bullish for the precious metals in terms of devaluing the existing fiat currency.
Looking ahead, market analysts broadly expect silver to average around $45 per ounce by the end of 2025, with strong momentum pointing toward a possible test of the $50 level, a psychologically important threshold that has acted as resistance since 2011. Surpassing this mark would require a unique alignment of factors: robust industrial demand, sustained investment inflows, heightened global financial uncertainty, and ongoing weakness in the US dollar. Hemke points out that today's macroeconomic backdrop increasingly mirrors the conditions of past monetary crises, when confidence in paper assets faltered and investors shifted rapidly toward tangible stores of wealth. Could silver simply retest its old highs? Or are we on the verge of witnessing a generational breakout that propels it far beyond levels seen in the past? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.